So this is lesson 11 today, and here we're looking at a balance sheet and an income statement. Right, so this is the income statement over here, which we just done in lesson 10, where we had a gross profit margin of 46%, a net profit margin of 20%, return on capital employed of 34.5%. Now, in terms of profitability, therefore, we can say that this business is doing very well, but we also want to have a look at the balance sheet. And what can a balance sheet tell us? Well, the big thing it can tell us about the liquidity of the firm. Now, this is this bit in red on here. So current assets, which is cash, debtors and stock, divided by current liabilities, which is short-term loans, and that will then give us our net current assets. Now here we can see that our current assets are greater than our current liabilities, so therefore our net current assets, which is current assets minus current liabilities, is also positive. Now what that means is that the firm's liquidity position is okay, but how do we get a number on that? Well, this is always the case that it is always ... 1, and as long as this number here, just say for instance if this number here was 3 to 1, that would mean your current assets were 3 times bigger than your current liabilities. Okay, however, if it was say 2 to 1, it'd be twice as big. If it was 5 to 1, your current assets will be 5 times as big as your current liabilities. However, if it was 0.5 to 1, right, your current assets will be half the size of your current liabilities, and that would therefore suggest a liquidity problem. Now, the textbooks say that you like this figure to be roughly 2 to 1. So your current assets are twice as large as your current liabilities. Now, in a sense, if it's less than that, then your firm has a liquidity problem and the firm could be at risk. Right. So look at this situation on here, and the liquidity is 2.8 to 1, because 66,862 divided by 23,983, if we work it out, it comes out roughly as 2.8. So you just put 2.8 ... 1, and that immediately tells us that the firm does not have a liquidity problem. Then we also want to look at the gearing, and the gearing we get totally from the balance sheet, which is just long-term loans, non-current liabilities. It's always a positive number, even though here it's negative because you borrowed the money. So it'd be 33 million pounds, this is 000 up here, divided by 33 million pounds plus 83,973,000. Now if we do that, we can therefore see quite quickly that the gearing is 32%, which means low gearing, because obviously 33 divided by 116 million is going to be about that sort of figure. So that's a gearing of 32%. So therefore the firm could borrow more money through gearing if it really wanted to. Now in this particular example we are looking at here, the firm wants to raise 200 million pounds to move abroad. Now what does that mean? It means therefore that if they did that, and they did it all through long-term loans, then their gearing would go up to 75%. Now therefore then the firm would have to pay interest on those loans back every month, and then that would place the firm at risk if the interest rate went up. So therefore that would be a high risk maneuver, so maybe you might want to borrow your money through shares. Right, so this here is a balance sheet, this here is an income statement, and these are the various ratios that we can get out from that system. So once we see all those figures, we can actually simplify this whole process down. This is what you try and do in business studies. You look at this firm now, and these are all the figures. Okay, it's got a ROIC at 34.5%, really good. So it's getting a high return on capital employed from the amount of money invested in the business. It's got a high gross margin, so it's making a lot of money on each good that it sells, of 46%, it's almost 50%. The net profit margin is 20%. We really need to compare that with other figures. The gearing is 32%. You're getting 32% from long-term loans. However, if they do borrow 200 million quid, that gearing is then going to go up to 75%, and that gives the firm a greater risk. The liquidity is roughly 3 to 1, so the firm has no cash flow problems, and the asset turnover is roughly 2.4 to 1. Now, sorry, 2.4. Now we really need to compare that also with other figures, but those figures immediately tell us a story that this firm is pretty good. Now, what other things will we have to look at? We'll have to look at its brand, at its management team, its brand, its management team, the other competitors within the industry. We need to look at a whole host of factors, and we'll be looking at those slightly later on as we progress through this course. But there we go. Okay, lesson 11 over. Thank you.